What's up, everybody? In this video, we're going to be talking about a Cathie Wood special. We're going to be talking about a stock that Cathie Wood was buying years ago, and she no longer owns anymore. That's right. We're going to be talking about a company that was ahead of their time, I believe, and that I believe now that AI is coming together, they are in the right field to advance forward and make a killing in this market. In this video, we're going to be talking about UiPath, ticker symbol PATH. And as such, we're going to be talking about the valuation, we're going to be talking about the bull thesis, and then later in this video, we're going to get into the technical analysis and what I'm seeing on the charts. So if you appreciate this video and these types of videos, do me a favor, smash that like button. And if you're not already subscribed, consider subscribing if you think I've earned it. All right, let's get into it. First, we're going to be looking at a thread that I posted on X a couple days ago, talking about UiPath, what they are, who they are, how long they've been around, and what they really do. So just going over the highlights here, UiPath are a robotic process automation company. They are the leader in this space. Essentially, they have these tiny little bots that kind of do all of the work for them. They were founded in 2005 in Romania, actually. And today, Path provides software that automates repetitive, rule-based tasks, allowing businesses to enhance efficiency, accuracy, and productivity. So essentially, they take all those meaningless and minute, not meaningless, but minute tasks away from employees, and they automate them through their little robots that do different things. Essentially, they are the future of automation through agentic and robotics, and essentially, obviously, this is an AI play. And as I was saying earlier, 2005, no one was really talking about AI. Even just a couple years ago, no one was really talking about artificial intelligence at this capacity. So yes, again, I believe they were ahead of their time, but I believe now is the time for them to strike and to continue to accelerate that top line revenue growth and continue higher in their stock price. And I didn't say it earlier, but I do believe this is a 5 to 10x opportunity on this name, as they are currently around a $7 billion market cap. And as such, I believe that they can rise to a $100 billion market cap or more. So moving on, essentially, you can see on the infographic here, they discover, automate, and then operate. So they identify the highest ROI opportunities for continuous process optimization and automation using the power of AI. Process mining, task mining, communications mining, idea, capture, and management. Then they automate it. They rapidly build AI-powered automation that seamlessly collaborates with people and systems to transform every facet of work. UI plus API automation, low-code development, generic AI and experiences, intelligent document processing and specialized AI, process orchestration. Then they operate. They establish an enterprise-grade foundation to run and optimize a mission-critical automation program at high scale. Real-time and trend analytics, continuous testing, unified management and governance, and cloud-first flexibility. So, moving on, this is the breakdown of agentic automation delivers the last mile of AI transformation, complex and variable workflows, moving into autonomous decision-making, and then trusted enterprise AI are their three pillars of this next phase for them. Moving down here, they are the best in class in automation, enterprise-grade accuracy and reliability, end-to-end agentic orchestration, equal access to third-party systems, trust and governance. A global network of partners, as you can see, from Amazon to Microsoft to Google to Workday to DocuSign, Adobe, CyberArk, and other partners include Cognizant, Accenture, and SAP and IBM. Even more global partners, including Spotify, Canon, Uber, DHL, Thermo Fisher, and Xerox and Lenovo. So as you can see, they already are partnered with tons of great big companies, Fortune 500 companies, and they have plenty of room to continue to grow, and they have plenty of people to continue to sell their services and upcharge and continue to drive more growth through those companies. This is the driving durable growth over the last 2 years, really, 3 years. And as you can see, they are continuously growing at a pretty good clip, about 17% growth rate year over year as of the third quarter, as of this last quarter, and essentially 113% dollar-based net retention. If we look a little bit deeper, they're at 1.61 billion essentially, with an average revenue rate of average recurring revenue growing at 17% year over year. Their annualized invoice amounts per solution, their SKUs from term subscription licenses and maintenance obligations, assuming no increase or reduction, and 113% dollar-based net retention. Total customers 10,790, so they have a massive customer pool, and they have 2,235 customers with over $100,000 annual revenue rate for them, or annual recurring revenue through 2,235 customers. So obviously you see there that there's definitely room to increase the $100,000 or more annual recurring revenue rate from these customers. Moving on, their TAM is very, very large. As you can see, $60 billion is the expected total addressable market that this is supposed to grow to. This is written by Forrester. Automation promises to change the nature of what an organization is, what a company does, and how work is done. So essentially, that tells me that these bots are going to be able to essentially cut down on employees and making these tasks more automated just by paying the subscription to Path, UiPath, and essentially being able to cut out workers, healthcare, all these other things, all these other deep payments that they have to do for each employee. Also, 2024 Gartner Magic Quadrant for robotic process automation. UiPath named a leader for the 6th year running. So it's not me saying they're a leader; it is the overall industry. So now that we kind of talked about what UiPath is, what they really do, and how they're really breaking through in these markets and all their customer base, let's kind of look at the valuation now. Let's look at them a little bit deeper through my high five investing spreadsheet here. So essentially, as we kind of go through this, I'll kind of highlight the key parts of this. Up here, we're really just showing, a $7.67 billion market cap. We're showing a 52-week low, 52-week high, and we're showing a current price of $13.95. Next, we get down into the free cash flow margin rate. The free cash flow margin rate, this is for the first 1 to 5 years, and then this is for the next, or the last 5 years. This is an obviously over 10-year analysis on this company. So essentially, we're seeing what we should be paying for this company today with assumptions going out all the way 10 years. And I'm not going to be using my assumptions. I'm going to be using analyst assumptions, which after looking over them are pretty conservative on the revenue growth. And I believe that they can actually accelerate even more on the top line revenue growth than what analysts have them at. So I'm perfectly fine taking analysts' conservative run rates on revenue and EPS into mind, because in my opinion, this is telling us is a $24 stock. So it's essentially saying this is worth $10 more than what it's priced at today based off conservative analyst analysis. And that tells me that we have a very good buy here, in my opinion. So the free cash flow margin rate for the first 5 years is going to be 22%. And they're actually doing about 22% or more free cash flow margin rate as of this time. Free cash flow margin rate is essentially the revenues that they bring in, and the percentage of that goes into the free cash flow. So the amount of free cash flow they have from their revenue is about 22% right now. I believe in the last 5 years, they can grow that to about 30% of their revenue to be free cash flow. And free cash flow is king. This is basically a discounted cash flow model, and that is obviously Warren Buffett's favorite tool to value companies, and it is mine as well. Now, we have a discounted rate of 10%, and then we have a terminal value, a multiple free cash flow of 25. So a terminal value of free cash flow essentially is saying at the end of the 10-year mark, what is the price that people would pay for the free cash flow that UiPath is bringing in? And to me, in my opinion, I believe 25 for a leading AI robotics company that has these RPA robots that's integrated with all of these different Fortune 500 companies is a great buy. And they will continue to accelerate revenue growth, and they're going to be in a lot more favorable position in the next 5 to 10 years than they are right now. So essentially, I put a 25 here. You can even go down to a 20, and you still see that we have a $21 fair value or intrinsic value rate. If you want to go a little bit more conservative, if you want to go a little bit more like a 30 PE or a 30 free cash flow margin, then we're looking at about 28. But I'll keep it at 25. Essentially, right now they're pulling in $1.46 billion in revenue. Out of that revenue, they're pulling in about $300 million a year in free cash flow, and they're actually giving stock-based compensation of about $359 million. So they are giving more stock-based compensation than they are actually pulling in free cash flow. But if you are an investor in Palantir or some of these other companies, you realize that they, at the early stages and when they're really picking up their growth, and they typically give more stock-based compensation than they do bring in free cash flow. That's just where we are at right now with companies like Palantir and UiPath. I'm not too concerned about it, and I think as they continue to grow and up their free cash flow, they will start dialing back on this number a little bit. Their net cash to net debt difference is about $50 million. So they have $50 million of about net cash compared to net debt. And then essentially their shares outstanding are 551 million essentially. So you see down here, if you're not interested or if you don't know what a free cash flow yield is, basically your free cash flow yield and your forward free cash flow yield, this is just telling you how much you're paying for the free cash flow in this company. So you are getting, and what your return is. So your return on the free cash flow in this company, if you bought it today, is going to be essentially almost 4% current, and then a forward free cash flow yield of 4.18%. And we have a current PE with current EPS's pegged for this year of 49 cents, forward EPS of 52 cents for 2026. And essentially you are paying 28 PE and then about almost a 27 forward PE on this company. And you see these EPS numbers are going to continue to grow at a pretty decent clip, up to about $1.29 by 2033. Finally, to get in here to what you all have been waiting for, the intrinsic value. The intrinsic value is calculated by taking in the revenue growth and by taking in the free cash flow margin rate, running those numbers together. And as you can see, we start out with a 10% and then essentially continue downward to about a 6% revenue growth rate, which again, I believe that is very, very conservative. I can see this company honestly growing at 15 and maybe even a 20% plus growth rate. I'm not joking, I'm serious about that, because I believe the adoption of these RPA robots is going to be massive in the coming years. Not just the coming years, but honestly, starting this year. I believe that the adoption of these RPA robots is going to be massive right here, right now. And as such, I believe that the revenue will continue to increase and we will continue to see a massive free cash flow start pouring in for this company and EPS start skyrocketing. So again, we have increasing revenues, and essentially we're getting this company at a current margin of safety of 42%. And the intrinsic value again is $24 per share. So, and then our CAGR, our 5-year annual CAGR is about 23.7% annual CAGR rate. And then our 10-year is about 16% per year. So again, this is moving it to $40 or to $62 in 10 years. But again, I believe that we can actually move a lot higher than that. If we were to get to 15%, even 20% revenue growth rates or more, we're going to be looking at massive numbers. So if just this upcoming year, let's just say this is 2026. I know it's not right on the screen, but let's just say we get to 15% revenue growth rates and we hit 15% for the next 3 years, jumping up to 20% for 2 years, and then back to 18, 16, 14, and then 12. Now you see that our intrinsic value is $38 per share with a current margin of safety of 63%. And as such, we obviously see that our annual CAGR rate jumps to 36% for the next 5 years and 21%. And we get to about $100 per share, which is essentially a 6x from here in just a couple years. So we're not going to do that. We're going to stay conservative on this. We're going to buy low and we're going to wait until those numbers get better, like I think they will. But essentially right now, as I see it, this is a very, very good company and a very cheap company for what they're doing right here, right now. So next up, and finally, we're going to get into the technical analysis of this company. As you can see here, we're looking at a monthly chart. Now with investing, I like to look at a monthly chart because it tells us more of a direction of where we are going. I will also be looking at the weekly chart here in a minute. As you can see here, I believe that we can get back to all-time highs and more of $90 and higher. This red and green line is essentially my high 5 indicator that I built. It's my personal trading strategy. And as you see here, we are starting to flip green. Not only are we starting to flip green, but we have already had what I believe to be a double bottom. A double bottom is a charting pattern where you come down, you touch a local bottom, you pop back up, you come back to that same bottom, and then from there you continue upward and higher. When you break this neckline, essentially, the high that you made after the first bottom was made, once you break that, essentially you have a double bottom breakout. And with a double bottom breakout, you are essentially going to have a measured move. That measured move is to $45.40. So on a technical analysis as well, we have flipped to green on our high 5 indicator. We're about to cross bullish, make a bullish cross through the smoothing line. And as such, we will continue higher over the next couple months and years. So as you see on the monthly chart, we also have a large volume shelf. And as you see up here with the Williams percentage range, we have higher lows continuously being made as we climb higher on this trend line. And as we climb higher on this trend line, we're getting very close to breaking out of this bearish Williams consolidation box. Williams consolidation box is another personal strategy that I've made based off of the Williams percentage range indicator. And essentially it means whenever you form a box at the low down here, it is a bearish box. As long as you stay in that box, your price will continue to fall lower. A bullish consolidation box is just the inverse where you create one up here. And as you stay within that box, you will continue higher. So what I'm really getting at here is once we break out of this bearish Williams consolidation box, we should continuously move higher. and go to form a bullish Williams consolidation box if we get all the way up here. Because as you see, we swing from one end of the pendulum to the other end of the pendulum, and so on and so forth. But whenever we get in these areas, we usually consolidate for a little bit, and then we run the price higher. So, like I said, we have divergence here, and we continue to make higher lows, and as such, we should continue higher. If we get this bullish cross and we break over $28-ish, then this name will really start flying, in my opinion, up to 45 and then start making its way to $100 per share, as long as, of course, the fundamentals continue to follow the company. Last I want to get into here is looking at the weekly chart. Again, you can see a little bit more clear the double bottom that has formed. We have broken down, touched once, broke up, touched again, and now making our move higher. On a shorter time frame, you can see that we have this rounded bottom taking place. And with a rounded bottom, essentially it's exactly what it sounds like. It's where the stock comes down and then makes this low and then starts to curl up. Right now, we are starting to curl up. We have a beautiful symmetrical triangle pattern that's forming and going to get tighter and tighter. And essentially, we will either pop to the downside or to the upside. In my opinion, based off the fundamentals, AI, what AI is doing, and the fact that the next phase 2 of AI is phase 1 was hardware, phase 2 is going to be software. And as phase 2, this company obviously is positioned very, very well for that phase 2 of software to continue higher. And again, I believe the downside is limited in this name because I believe that they are a buyout candidate for a larger company because of what they offer in their tech, their AI, and their products, and their current partnerships with all the companies that they are currently working with. So, as such, I believe that the downside is limited because of the buyout possibility as well. So, with this rounded bottom and with the symmetrical triangle pattern, if we do break out here, which would be around $15-ish, we are looking at moves up to 18, 20, 23, and then a measured move up to $28. So you can see everything is starting to really turn around for this company and start to look bullish. And as such, I believe that we are getting very, very close to a big move in a 5 to 10x opportunity for UiPath. Again, Kathy Wood was a buyer of this name years ago, and she had sold out since. And she was very bullish, but I just believe that they were a little ahead of their time, especially starting back in 2005. They were pioneers of this technology and what they were trying to do, and I applaud them for that. And I think they are going to be rewarded here very, very shortly for what they have built and what they have done for this company going forward. These partnerships will only grow and thrive, in my opinion, and they will only bring on new customers and new companies onto their annual revenue run rate. So, as such, I hope you enjoyed this video. I am very bullish on UiPath for a multitude of reasons that I showed you through the fundamentals, through the technicals, and just overall through what the company is doing and has done. I believe the time is now for Path, and I believe the future is very bright for this name. Of course, none of this is financial advice. We all need to make our own investment decisions and trading decisions going forward. But I do appreciate you sticking around to the end of the video, and I do appreciate a like and a subscribe from you if you did appreciate it and you think I earned it. So without further ado, I hope you enjoyed this video, and I hope you have a great rest of your day. I'll catch you in the next one.